Today we want to get back to our discussion about banking and the uses of funds for banks. If you recall, they've got these dollars coming in, now they've got to put them to work. The first two things that banks do is they acquire liquid assets we called primary reserves and secondary reserves. In a meaningful sense, banks have very little control over primary reserves. Now, there's one item in there, the excess reserves at the Fed, that they don't have to hold. Banks can control that. And so what happens is when a deposit comes in, you remember this story, the bank, if it's a checking account, they have to set aside 10% at medium-sized and large banks, set aside 10% on reserve. But if $100 comes in and they set aside 10% into required reserves, the other 90%, the other $90 of the 100 is an excess reserve. It's liquid assets, it's at either in the vault or at the Fed, and they don't have to hold those, so as soon as possible, they get rid of those. And so even though it's possible to have four of these items, the required reserve, the excess reserve, correspondent balances at other banks, and then check items in the process of collection. Even though there are four items here, banks try to keep one of those at zero. And the way they do that is they say, hey, if we need liquidity, we're not going to keep the funds at the Fed, we're going to acquire secondary reserves. These are liquid assets also, but they earn interest. Okay? And usually not a lot of interest, but still they earn interest. And I gave an example of some of those. Self-fed funds. Or the same thing with the repurchase agreements, which is the collateralized Fed funds. A third thing, Treasury bills. A fourth thing, a CD issued by, a marketable CD issued by some big bank. Another thing, commercial paper. These are the types of things that banks hold for liquid assets. Now, after bankers get all the liquidity they need, they don't want any more. They always need liquidity and they need to hold enough, but they don't want any more because the interest is either zero or at a very low rate. Okay? And so after they get all the liquidity they need, then they say, our next concern is profit. And so to earn a profit, they make loans. And so really, if you look at this, and we're doing 1, 2, 3, and there will be another category, we're talking about these in order of priority. What does the bank do first with funds? The first funds it gets, it's got to hold some extra or some required reserves. So the first funds coming into banks start holding these primary reserves. After they've got all the primary reserves they need, then they say, hey, more dollars coming in, I'm going to get some liquidity, but secondary reserves. And as the dollars keep coming, then they say, I don't need any more liquidity. I don't need any more whatever these primary reserves are, correspondent balances and so forth. Now, my next thing that I need is profit. And even though it's third on the list, the dollars have to sort of filter down to this level. Banks want to get as much as possible to the profit category. This is about 65% of bank assets. It's roughly the value of all the deposits coming in at banks, roughly. There's no necessary connection. I'm just saying that's about 2/3 of bank assets. Let's talk about loans just in general terms. Loans are promissory notes. What does that mean? Technically speaking, a loan is not an IOU. You know, that's easy to say IOU. But that is not what a loan is. Here, an IOU says, I owe you money. I acknowledge the debt. It doesn't say I'm going to pay you off. It doesn't say I'm going to pay interest. It says, I owe you money. What you really are talking about with a loan is a promissory note. I promise to pay you under certain circumstances, on certain dates, at an interest rate, and so forth. It's a promissory note. Okay? There are other aspects of this. There are fixed versus adjustable interest rates on loans. It depends on who's doing the borrowing as to what's most common. Most of us, when we borrow money, most of us individuals are going to get a fixed interest rate loan. That's most of us as individuals. Most home loans, 2/3 of home loans, for example, are going to be fixed interest rates. That's a ballpark figure. Most of us will get a fixed interest rate on a car loan. We go in, we negotiate, we say, what's the interest rate? They tell us a number, we say yes or no. Fixed interest rate. A lot of business loans are adjustable interest rates. There's a formula, and they say something like, okay, here's how we set the interest rate on your loan. And as supply and demand changes in credit markets, we already went over that loanable funds model. As supply and demand changes and interest rates change in credit markets, then the interest rate you pay will change also. And roughly a third of home loans are set that way. There will be a formula there, and it says as interest rates and credit markets change, your mortgage interest rate will change. But anyway, so most of us, like I say, as individuals are going to see the fixed interest rates. Another aspect of loans to highlight is term versus call loans. Most of us as individuals are going to have term loans where there is a specific maturity date. Here's a home loan, it's a 30-year loan. Here's a car loan, it's a 4-year loan, and so forth. Specific date. There are call loans that most of us as individuals do not get, but much more common for business borrowers. Here's what a call loan is. It can be ended at the discretion of either the borrower or the lender. You could go to a bank, negotiate a call loan, usually at a pretty good interest rate, and the understanding is this: the banker can call you and just say, hey, at the end of the week, Friday, we want that money back. And you say, oh my gosh, I borrowed $1 million from you. And they go, yeah, and that means bring me $1 million Friday. And you go, where am I supposed to get that? And what's the answer? Rob a bank. I don't know where you're going to get it. No, they don't say rob a bank. Here's what they say. I'll tell you what. Assuming that you're a good risk, you come in and you sit down and we will issue you a term loan. We'll make you another loan and you can pay that one off. That's very common. If they just kind of have their doubts about you, they might just say, I don't know where you're going to get it. You bring us that money. And if you don't bring us that money, then you're in violation of our agreement, and we'll take the next step. Whatever's next. You've got collateral out there. You own that building. Well, that'll be our building. Or whatever the agreement is. But the point is, call loans, term loans. Now, how would you like to do that? Go out and borrow, I don't know, $10,000, $50,000, $100,000, $1 million. How would you like to go borrow a bunch of money? And every time the phone rings, you say, oh my gosh, hello? Yeah, bring us $1 million. Just stop answering the phone, right? That won't do it. They'll send somebody out. So you cannot really avoid that. And by the way, when it says call, that doesn't mean telephone call. It just means it can be called back in. So here's the deal. Borrowers kind of hate that. And since borrowers kind of hate it, that reduces the demand for funds of those kind. And the reduction in the demand for funds pushes the interest rate down. And then the lenders, how do they feel? They love that. If they give you money and you don't have to pay back for 5 years, they're going, oh, okay, I mean, all right. But if they could just call you up and have that money back at the end of the week, then they go, that makes me feel good. So those suppliers say, ooh, I like those call loans, big supply of funds. So if there's not much demand and there's a big supply, both of those are pushing interest rates down. So what you're going to see is call loans, low interest rate. And then you're going to see term loans with a higher interest rate. Yes, sir. Pardon me? Oh, they spent the money. That's why we borrow money, right? We don't go out and borrow $1 million and then just put it in a trash can or something like that, or like in the bottom drawer waiting for the phone to ring. We spent that money. Well, that's your problem. How do you pay it back? I don't know. Call another banker. Come see me. I'll convert this to a term loan at a more favorable interest rate for me. Or sell some bonds. You know, you got other assets, you got any bonds, you got any corporate stock, sell them. Bring the title, the deed to your property down here. We'll make you another loan. Or we'll just take your property. But you know, you don't get that call loan where you just say, well, look, if you call me and you want that $1 million back, maybe I'll give it, maybe not. They'll get it, right? Because that's $1 million. So, I don't know, maybe, I think they'd start off breaking a few fingers. Just kidding. Anyway, but how do they get it? I mean, that's what happens when there's a call loan. By the way, There are some people that go borrow money, not only from a bank, but from stockbrokers and stuff like that, but they're borrowing money to buy stocks and bonds. And those are call loans. And sometimes the phone rings. I've had these phone calls. Hey, this is a margin call. You owe us money. Oh, I do? Yeah. It's 1 o'clock. Why don't you get down here by 4 with that money? For what day? No, for today. Oh, okay. Now we've got 2 choices. Either you bring us money, meaning just bring them a check. Better be a good one. Or break the fingers. No. Or they say, we're holding some stock of yours down here. We'll sell the stock. Market's still open. But we got to have our money. This is our deal. And you say, okay. And then you either sell the stock or bring them a check. And now, the point is, though, don't get into these deals if you just go, I don't have any money. Well, then don't be doing that. Get a term loan when you know when it's got to be paid off. There are monthly payments and so forth. Were you going to say something?
I was just going to, don't term loans have an acceleration clause in them?
An acceleration clause?
Yeah, like, let's say that you're not living up to your end of the agreement completely.
If you don't live up to your end of the agreement, then that's what we call default.
Yeah.
And then there's no more deal. Hey, we got a contract with you. It doesn't say I owe you.
Let's say, for instance, you're making your payments, but the collateral has deteriorated. So it's not worth as much. Can they accelerate the note?
Then what they can say is this. Look, you on this promissory note, it says you're going to have such and such collateral. Now you no longer have that. Bring us collateral. And then they may work out with you the details of how long, or they can just say, oh, you're not going to bring collateral? Is that what you're telling me? Okay, then you know this piece of paper we got that we all signed and you didn't live up to your end. We want our money back. And by the way, that is fair.
Oh, yeah, it's very fair.
I mean, it's not fun, but it's fair because here's the deal. When you go down and the bank gives you this note, and you sign notes, and you sign that note, and they sign that note, you hold your hand out and say, give me my money. And if they said no, what would you say? Hey, you crook. They give you that money. They write you a check right then. And if they don't, right? I mean, hey, I'm calling the police. Are you kidding? I just signed this piece of paper. I promised to make all these payments to you. You're giving me nothing? And so as soon as they give you, and they fulfilled their part of the deal, it's up to you to fulfill your part of the deal. And if it's tough, then you know what you do is you go down there and sit down with them and say, I need to talk to you. I got a terrible situation here. I know I signed that. I know you got that money coming. You haven't done anything wrong, but I can't live up to the deal. What can we work out? And if you don't do that, and if you just stop answering the phone, stop going to the door, stuff like that, you're in trouble. I don't think I told you about one time I had a bank account at one bank, and I borrowed money for a house at another bank. And so then I signed up for automatic payments, just electronic transfers to be made between these banks to make these house payments every month. And so then what happened was one time my phone rang, and I said, hello, and I said, Mr. Wyrick, and I said, yes. And there was a woman on the other end and just had a very soothing voice, and she said, oh, I wanted to just call and see if you had had a chance to make your house payment. And this would be like the 10th or 15th of the month. I wondered if you had had a chance to make your house payment this month. And I said, oh, yeah, I'm sure that's been taken care of. And she said, oh, okay, well, we'll just check our files. And I said, okay, thanks, bye. So I hang up. And then like 2 days later, hello, Mr. Wyrick, this is whatever her name was, Nancy. This is Nancy over at the bank again. And you know, we checked and we just haven't seen that come in. And I've waited a couple days here, you know, time for the mail to be delivered here the last couple days. And nothing has shown up. And could you check that again and see if you paid that? And I said, I know it's been paid. There's no question about it. It's paid every month. And she says, oh, okay. if you wouldn't mind, just check into that. And she's very soothing, you know, like, so I don't like run, I guess, to Mexico. And so then I just think nothing more about it. This is done. I mean, it's been going on for years, you know, no problem. So then a couple days later, Mr. Wyrick, this is Nancy over at the bank again, and we were going to have one of our, I can't remember now the term, but our couriers will be out in your neighborhood in about an hour or two, and just wondered if they could stop by and get that check from you. And I said, no, I'm not even going to be here in an hour. I got to go to work. And I said, I don't know what's the matter down there, but I've been paying my bills, and you guys have dropped the ball. I don't know what's the matter. Oh, we sure would like to have that courier stop by. And I said, well, I'm not going to be here. I'll be calling you again, Mr. Wyrick. Yeah, whatever, you know, so. And then, like, the next time, there's a courier showed up, and so I give him a check. This was like 4 times. And so then, I'm thinking, what in the heck is going on? So, come to find out, I mean, it took a couple days to backtrack, but I called the bank and I go, what the heck is happening? This other bank is calling me and they didn't get their money and stuff like that. And they go, no, we sent the money. You know, my checking account bank, we sent the money. I don't know what's going on. So this went on for a few days, and there were a few phone calls back and forth. We sent the money, yeah. But in the meantime, I gave the courier another check. He was very pleasant, a young man, about college age. Here's what happened. The bank that I was doing checking account with, it was taken over by another bank with a headquarters in, I think, St. Louis. And then they had new, you know, like their accounting and paperwork and computer software and all was different. And they converted all these things, you know, here at this local bank over into their software and stuff like that. And so I automatically had this payment being made to, at the time it was Boatman's Bank. Boatman's no longer exists. It's been taken over by a couple times by other banks. Anyway, so they've got this deal, automatic payment to Boatman's Bank. And so rather than making a payment to Boatman's Bank in this town, they sent it to Boatman's Bank where the bank holding company was, the headquarters. That's the address they had in their software. And so what happened was my monthly mortgage check was sent to St. Louis, and somebody, and this all got backtracked, and they said, oh, I wonder what this is. And they set it down over in a box, like a cardboard box of mail that came in, and they don't know who it's for. And there it sat. And it sat there for like 3 weeks before this all kind of came back. And they said, oh yeah, we wondered what that was about. So anyway, meanwhile, I found out how banks follow up on these kinds of things. But they were going to get their money, and you know, like I dodged the courier once. And honestly, the first like 2 phone calls, it's just like, there's some mix up. And that's what I told them, you're just confused, it's there. And then come to find out, no, it wasn't there. Their money was sitting in St. Louis. But by the way, their banking company had the money. It's just that not the local bank that was supposed to get it. It was the bank holding companies. They had their headquarters up there, and that's where it was all sent. Anyway, they're just thinking, we got a deal. And you live up to your end, or just pay us off. That's okay. If you don't do your part, that means you don't want to do business with us anymore. So you go your way and we go our way. But when you go your way, you pay us off and we'll be even. So anyway, we got that all straightened out. Oh, by the way, then, and I would advise this if you get into this situation, I went down to my bank and I asked to talk to the president, actually a branch manager, and I said, hey, you know what I want you to do? I want you to go in there and dictate a letter, and you write that letter and send it to the bank that loaned me the money for my house. And you tell them this was your fault, this is not my fault. And they said, oh, okay, we'll do that. And so then that all got straightened out that way. She was so nice though. Oh, Mr. Wyrick, you know, and always kind of whispering and like didn't want to spook me, I guess. And I was kind of spooked after about that. The first time she said, we want a courier to show up, and it was very inconvenient for me, so I said no. But then I knew when they called back, the courier's going to, they probably told him to beat me up and break a couple fingers if I wouldn't pay. So I paid. Secured versus unsecured loans. And secured loans versus unsecured loans refers to collateral. Security is collateral. So there are collateralized and uncollateralized loans. Now, most of us are providing some kind of collateral when we borrow money, right? A house would be the biggest loan most people get, and the way, and I've already put the numbers up, but the way that normally would work is if you're buying a house, and we'll just use nice and easy numbers for this. If you're buying a $100,000 house, very often what they want you to do is put down $20,000, 20%, as the down payment, and then they would make you a loan of the difference, $80,000. Okay, and then the house itself is the collateral. And that house has got your name on it, but then the lender's got their name down there on that deed. The house has got your name on it, nobody else's, but on the deed that gets recorded downtown, there's somebody called the recorder of the deeds. It officially keeps track of who owns these properties. But on that deed, it has the lender's name. And so that means that that house cannot be transferred into somebody else's name without making sure that that lender has been paid off. So anyway, with a house, you borrow the you borrow the $80,000, and then you put this $100,000 house up as collateral. And that says, if I don't pay you, you can come out, seize this house, sell the house, the terminology would be on the courthouse steps, but sell that house, get whatever you can out of it, the bank would, recover its money, and then anything left over. Like if they could sell that house for $95,000, they would keep $80 and give you back $15. Okay, the only thing is, if you wanted to be out of that house, the easy thing to do is get yourself a realtor, put the sign out front, take some time, and if you'll put your house out there for 2 or 3 months, you'll get pretty much whatever its market value is, maybe $100,000, more or less. But if they take that house and say, we're going to sell it today or this week, they're not going to get $100,000 this week any more than you could get $100,000 out of your house this week. It takes time to do this stuff. A lot of people want to look at it and walk through it and things like that. And so anyway, a fast sale means they're not going to recover, except for in unusual circumstances, anything like its full value, they're going to recover $80,000 bucks. But that's a collateralized loan. By having collateral, that lowers the lender's risk. We've already talked about this riskiness and how if there's more risk, higher interest rates. So if there's collateral, if the loan has security, then there's going to be a lower interest rate, other things being equal. And many of us cannot get an unsecured loan, a loan just based on our signature. And a lot of us can't get loans of any size with just a signature. Very often the people who can do that was already somebody who's rich. That's a low risk situation anyway. So the person who's a wealthy person might go down and say, I don't have a lot of cash, but I have a lot of assets, just not liquid assets, and get a loan and maybe not provide any security just because it's known that they're a low risk, and then they might get that loan at a low interest rate. But they're getting the loan at a low interest rate because they have a lot of assets anyway. Okay, but for other things being equal, if we just get 10 people and line them up, then for those people, the ones who have security and collateral, those are the people who get lower interest rates. The bigger this down payment is, this is a little bit like we were talking about the bank's capital. This is like a little bit like that same idea is here's what you put in, this down payment, and the more you put in, the safer that loan is for the lender, right? You remember we were talking about deposits and borrowing and capital, and the more capital the owners put in that bank, the safer that bank is, the less likely it was to go broke. Well, the bigger this down payment, the safer that loan is. Sometimes there's a 10% down payment, sometimes less. And sometimes there's what they would call a 100% loan, no down payment. If a bank loans you 100% of the value of that house and then you stop paying and they've loaned $100,000 and they go out and seize that and they have to sell it, that bank's going to take a loss. Probably. I mean, it's possible they wouldn't, but very likely they're going to take a loss. So that collateral is what makes that bank or that loan safer. Okay, so these are just general things to be said about loans. Let's talk about a few different types of loans. We're still talking about banks, remember. The number one loan at banks, I'll say A, real estate loans. By the way, sometimes the term is used mortgage. Mortgage loans, real estate loans. Okay? This is about, and it changes from year to year, but about 60% of total loans. Ballpark figure. Okay? These are very safe. There's collateral, and that makes them safe. And FHA, VA guarantees. FHA, Federal Housing Administration, VA, Veterans Administration. These are government guarantees for basically lower income people and for veterans. And what's happening is this, is the government is saying to the lender, the bank, savings and loan and so forth, hey, if you loan this money, we, the government, will make sure you don't lose on this deal. If they can't make their payments, then you take the house, you sell it, and then we'll come back and make sure that you didn't suffer a loss. We'll make up for any shortfall when you sell that property. Shortfall, if there is any. Okay, so these are safe. I mean, home loans are safe if you don't get in the business of making 100% home loans or 95% and things like that, which banks have done over the last decade. Why? Why would a bank make a 100% loan or 95% loan? Well, more interest, but yes, sir. Housing prices were going up, so there was always this fiction of, oh, I'll lend you $100,000 on a $100,000 house. A year from now, that'll be a $110,000 house. 2 years from now, it'll be a $120,000 house. If I have to seize that house in a couple of years, I'm going to get my $100,000 out of it. That's one theory. That worked out. As long as housing prices are going up, it worked out. But they stopped doing that back in about 2000. I don't know, 2006, 2007 would have been the peak in housing prices. Also, banks would make these loans because they sell a lot of these loans. And in the old days, Fannie Mae and Freddie Mac, by the old days, a few years ago, Fannie Mae and Freddie Mac would say, we're not buying those 100% loans or those 90% loans. But then what happened is Fannie Mae and Freddie Mac, under political pressure, they started buying these loans, these, quote, subprime loans, these higher risk mortgages. They started doing, and then also investment banks started doing the same thing as Fannie Mae and Freddie Mac, which was come up with these mortgage-backed bonds and selling those bonds, and they started buying these loans from banks that were 90 and 95 and 100% loans. And so bankers would normally run from those loans, and then they said, I'm not going to run from them because somebody will buy them. Here. And they were selling them. And then those loans got in the hands of, like I say, Fannie Mae, Freddie Mac, those mortgages, Fannie Mae, Freddie Mac, or the investment banks. And then that meant a bunch of bonds turned out to be, lost money. So anyway, but we're going back in the other direction again where it'll be harder and harder. What did I see the other day? This is some advertisement. The president wants you to borrow money for a new house. That's what they say. Just come right out and tell you that. The president didn't say that. That's what some lender is wanting you to do that. And they want to lend you, subprime loans. They want to loan you money and charge you as much interest as they can and make you think everything's great. So anyway, I think we're, due to regulation and so forth, we're going back, and also just a lot of banks went out of business from making these bad loans. We're going back in this other direction. Okay. 15, 20, 30-year maturities are the most typical. A 15-year maturity is unusual. The most usual maturities is a 30-year loan. Let me draw you a little picture, because I know you like the pictures. Here's a 30-year loan. You get the money today, and basically what's going to happen, let me put a solid line, is you're going to just start making payments of, I wonder if I can do a calculation real fast. Here we go. I think I know the answer, but I'm not going to just make up something because, this is college. Yeah, I can make up some. What do I have here? A loan calculator. Let's take a $100,000 loan. $30 years, and I'm going to set the interest rate at 6%. And then, pardon me, here's our payments. $599.55 a month. Within 45 cents of being $600 a month. What did I say? This is a $100,000 loan, 30 years, 6%. That's our mortgage. And so you're going to make a payment of $600 a month for 360 times. And I know you're thinking, oh man, $600 a month. Yeah, well, think about doing it 360 times. Okay. Now, let's do a thought experiment here for a second. On the first day, and I'm not working with any down payment, maybe it was a $125,000 house, you put up a down payment, so they were lending you $100,000 or whatever. That's beside the point. On this single day, the first day, you got $100,000 borrowed from them, right? 6% interest. How much interest is that a year? Pardon? $6,000 a year. This is interest. Now, $6,000 a year. How much a month? Because these are monthly payments. How much a month out of that would that be? $500 a month. So I could come right up here and put a little mark that says, look, in that first payment, here's your first monthly payment of $599.55, right at $600. $500 would be interest. Is that making sense to you? Now, what's true in the second month? Well, here's what happened in the second month. You started off owing $100,000, but now you've paid off $99 and 55 cents, because you paid this has been so much easier if it was $600, but you paid $599.55. You owed $500 for interest, so $99.55 was to pay off the loan. And so you no longer owe $100,000. Now you only owe $99,900.45 cents. So you owe a little bit less than before. And so in the second month, you do not owe $500 in interest, because in the second month, what did I say? This would be $99,900.45. That's your balance for the second month. And so in the second month, the amount of interest you owe is just a little bit less. Not much less. How much less? It would be 1/12 of the annual interest, 6%, on $100. I mean, you've essentially paid off $100. So you're saving $6 a year in interest. And $6 a year in interest divided by what? 12, you're saving 50 cents. And so the next month you only owe $499.50 in interest. But in the second month you're paying off a little bit more of that loan. So the third month you owe a little bit less interest. And so what's happening is this. Over time, the amount of interest you owe on that loan is going down. And this is not a straight line, it's curvature to it. Okay, and it's going to go down, down, down. In the first month, what you owe in principal, $99.55, was here. It's just this difference between your $599 and your $500. That much is to repay the loan. And over time, that's going to go up. And so, why is it going to go up? Because out of your almost $600 a month, $599.55, if you owe less and less interest, there's more and more left over to pay the loan off. Now, what's this point? This is the point out here where half of your house payment goes for paying off the loan and half goes for interest. And it depends on the interest rate that you're paying, but this is occurring someplace, excuse me, out here at, I don't know, 22 years. I'm going to put a question mark, but it's way, way, way into the term of this loan before half of your money is used to pay off the loan. More than half of your money is going for interest most of the time of that 30 years. And like I say, there is no rule about how long that is. But this is a fixed rate mortgage. You see, we're paying a fixed interest rate, 6%. Okay, questions about this? If you have an adjustable interest rate loan, then what they'll do is each year on the anniversary of whenever you borrow that money, they'll send you a note in the mail and it'll say, hey, according to the formula we agreed on when we loaned you the money, the new interest rate on your loan is, it could be 6.5%, it could be 4.5%. I mean, it varies, it goes up and down. And so now your new house payment is, and then they'll tell you a different house payment. But this is the standard kind of loan that people get where it's a fixed rate mortgage and they have these fixed payments throughout the life of the loan. Most people, but not everybody, most people are not going to hold that house until they've paid that loan off because most people are going to move in 10 years or 15 years or something like that. Either move to a different town or move to a different house. Bigger house, smaller house. Anyway, this is the nature of the beast. And so, anyway, questions about this? These loans, the home loans, but not business, home loans are something called non-recourse. And here's what that means. If you stop making payments, the bank can come out and take your collateral, probably the house. For most people, that's what it is. If you stop making payments, you default on the loan, they can take your collateral, and that's it. With other kinds of loans, typically, with other types of loans, if you stop paying, they'll come take your collateral. If that's not enough, they just keep pursuing you. But here, with a non-recourse loan, they have no recourse. They can't go back on you any further than just the collateral. And so what people do sometimes is if they, let's say, buy a $100,000 house, they owe $100,000, and the value of that house goes down, then they just say, well, that was a bad decision, and they turn it back to the bank and leave. And the bank says, yeah, that was a bad decision. We shouldn't have loaned money to that person. Okay. I guess the final thing I would say is this. There are both, these are not only home loans, but home or business loans. That is to say, real estate loans include business real estate, commercial property loans. And that's how you'll normally hear this referred to. And these are really set up in a different way. Usually, what's going to happen with these kinds of loans, I mean, I've drew you a little picture here. This will be the nature of most home loans. With a commercial property loan, it's more like you're just paying interest. Let's say you go down and borrow $1 million to buy, I don't know, a strip mall or something like this. You borrow $1 million, and what you do is over the next several years, you just pay interest on it. And you're not paying the house off here, or the loan off. Here, you're paying the loan off. You start off paying $100 a month out of your $600 going to pay the loan off, and then more and more and more. Finally, in the last month, you're paying virtually everything of that $600. Virtually all of it goes to paying the loan off. There's very little interest due there. But this, the commercial property loans, is more like you're just paying interest, interest, interest. And then at the end of 5 or 10 year period, would be most common, then it's all due. And what do you do then? You go get another loan. Okay. Well, and maybe you've got some money built up where you can pay some of it off, but just go get another loan. Roll that loan over. So, and the terminology, these are balloon notes. Is that how you spell balloon? Anyway, I think it is. What did I start to say? Who's making these loans for commercial property loans? Largely, not totally, there's no rule, but the big lenders for commercial property loans are small banks. Community banks, a disproportionate percent of all these loans are made by, that is to say, these commercial property loans are being made by community banks. Okay, and that is an issue. I mean, whether those are safe or not. Okay, I mean, we normally think about, oh, the housing market got into trouble. A lot of these mortgage loans went bad, and that is true. But there are a certain percent of these commercial real estate loans that are going bad as well. Okay. Second, let me do some erasing here. Second category of loans that are very big, very well known, C&I loans. Commercial and industrial loans, these are business loans. We call these banks commercial banks because of this. They make loans to businesses. And this is mainly to finance ongoing business activities. Inventories, for example. Supplies. I won't get into a bunch of that stuff. Businesses need money for different things, need loans. If they need money for their building, then the business, it's not called a C&I loan, it's a real estate loan if they need money for a building. And then businesses also, here's inventories of two kinds. Retail inventories, the stuff you're going to sell. A car dealership will go down and borrow money, buy cars, put them out on the showroom floor and sell those. Same with a motorcycle dealership. So with a retailer that sells refrigerators or stereos. Okay. Another time, and by the way, a lot of just like drugstores, grocery stores, same kind of thing. They're buying inventories to be sold. Another kind of inventory would be a raw material inventory. Like a utility company could borrow some money and go out and buy a whole bunch of coal and then pile that coal up and burn that to generate electricity. Well, they borrowed the money, but it's for a raw material rather than for some final product. Let's stop there for the day. We'll pick up with the C&I loans next time. So long.